Welcome to the Inside Out Money Podcast.
Can't even recognize this place. Too many pieces of our past mistakes.
Hi, I'm Maggie, and I believe real change starts from the inside out. So let's work together to improve our money and our lives from the inside out. We will explore all things money and our relationship with it. Join me each week with a rotating set of co-hosts, friends, and interviews. Let's jump in.
It's time we going round and round and round and round and round.
Hey, Andrew.
Hey, Maggie.
Hello, everyone. Welcome to Inside Out Money. For those of you who might be new here, this is a personal finance podcast focused on redefining wealth from the inside out. Each week, I speak with a rotating set of co-hosts about a different financial topic to help you improve your financial mindset and tactics. Today, we have co-host Andrew, and we are talking about how much you need to retire. But before we get into that, Andrew, hi, by the way. Hello.
Hey.
You look different.
I have my adult headphones on. That might be throwing you off a little
That's
bit.
not it. You look...
I have my Inside Out Money shirt
That's
on.
nice. I don't have mine on.
What?
But I did. I know it's a long story.
You do have a good. You got it in the background, so that
I got
counts.
popsicles on my shirt. That's fun. It's not tie-dye, but it's fun. I just recorded with Erica. She had on her Inside Out Money shirt. So shout out to you guys. No shout out to me. No, you look different. Like you look like you have more gold in your life. Like you've got more wins on your belt, whatever they call it in the cycling community. More gold ribbons, gold medals. What do they give you when you win a bike race?
Gold medal. Yeah.
Yeah. Like on a lanyard around your neck.
Yeah, I got some nice hardware.
Wow. So tell us what you did this past weekend.
Yeah,
it's way more than I did, to be clear.
It was a big week. It was Masters Nationals in Augusta, Georgia, and so it was the big race of the year. And I last year I won both the time trial and the road race, and so I was trying to do that again this year. And
you were trying to defend your title, right?
I was trying to defend the titles. Yes.
Were there people that thought that, like, because you were kind of like new in the community last year, that you came in and like swept all these other people that had been racing for a while?
I had
anonymity on your side.
Thank you. On my side last year, definitely. And I knew it was going to be much harder, especially in the road race, because tactics play such a big part in road racing. I had 65 guys in my field, and I had 64 people looking for my wheel to follow. So it becomes much more difficult. But yeah, I put in a really solid year of training, and I was able to win both the time trial on Thursday, which was 20 miles, and then 60 miles on Friday for the road race. And it was insanely hot. It was
one of the hottest weekends
It
ever.
was the two hottest days of the year, basically. And on the starting line of the road race, my cycling computer was reading 122 degrees on the start line. Now, we were in the sun, but it was still 122 degrees on the start line. So
that's insane. Congratulations.
Thank you.
First off,
Thank you.
Insane. Second off, but that is just the heat and everything. And that you're one, and I mean, not insane because you prepared for this. You're really good. I'm in no way surprised, but that was a pretty amazing feat.
Thank you.
And then I'm over here talking about mouth breathing on my 3-mile leisurely runs.
Oh my goodness.
And Andrew, you finally chimed in a little late because you're winning, world championships and stuff. But you finally chime in. You're like, I'm kind of an expert on this. And I was like, oh, you gave me the best answer so far. It's a little nuanced, but you had the perfect.
Admit, I was laughing pretty hard when I saw that post on Instagram.
So you're definitely mouth breathing while you're winning these races,
absolutely,
right?
Yes.
You couldn't nose breathe your way to.
No.
Not possible.
Definitely full on get the mouth as wide as possible in order to get as much oxygen in as possible.
Well, let me ask you a logistics question. Do you ever get bugs in your mouth as a result?
Oh, yeah. Yep.
Because I get sometimes I noticed that happened to me when I was running with my mouth, and I was like, this is terrible. So I'm then putting my face down to try to not what do you just suck it up and take it? It's
on
extra
a really
protein?
buggy night and you're going through a bunch of bugs, you got to just tilt the head down and get keep the bugs out of your mouth. Yeah.
Okay. But don't you just get surprised sometimes and all of a sudden
sometimes
you're
you get surprised. Yeah.
Well, you just spit it out, or you just swallow it and take the protein, or what?
A little bit of both.
Okay. You ever get like a bee in your mouth? Anything great? Like,
I've had the worst are the bees that fly into your helmet and then sting the top of your head.
what?
Yeah, so I've had that. That's pretty common. I've had
And
that
you just
happen a
keep
couple
going?
times. Yeah, I've probably been stung 3 or 4 times in the past 2 to 3 years.
They
Yeah.
must not mean to get in your helmet. They must be getting caught in
No,
there and then they're
no,
just pissed off.
it's the worst. Yeah.
Because they're like, you're all of a sudden they get caught and they're just flying around like leisurely. They get caught in your helmet. They're going like 60 miles. Aren't you going like 60 miles an hour?
No, these on the downhills, 50
Okay.
miles an hour. But yeah,
Still
typically
50,
you're
that's
going
pretty fast
25,
for a
30 miles
bee.
an hour, right? Yeah. So the bees can be a challenge.
Well, right now I need to know how fast do bees fly. So bees, like the Western honeybee, did you know they only fly about 15 to 20 miles an hour? So when they get stuck in your helmet, they're pissed off and they're like all of a sudden feeling wind like they've never felt before. And that's why they're stinging your head. Okay, I don't know how we got here, but and how
Talking
we're
about
going to segue
talking about
from
mouth breathing.
yeah, Western honeybees to how much do you need to retire? So this topic, Andrew, I feel like I've said this on many topics lately, but it just is true. Many people have requested this topic, but actually a better way to say that is many people text me or DM me or email me with this question. And I'm always like, I can't answer it in like a, quick pithy paragraph or a response to a message on Instagram. We're barely going to be able to cover it in one podcast episode because it is incredibly nuanced, right? The answer is it depends.
Yeah, it definitely depends. But if you think about it, it's kind of like the fundamental question of the financial independence community, right?
Yeah, that's true.
It's kind of the end goal for most people to achieve, right? Right. Financial independence, kind of the definition of is you essentially retire, right? You don't need to work anymore to support your lifestyle with a paycheck. So it's kind of the end game. So it's not surprising that people have a lot of questions about it. But it's a great topic. You can kind of pull together a lot of different things within this topic.
Yeah. And so we'll do our best today to explain what it depends on and the different factors and nuances that you need to think about. But the reality is it's very nuanced and there's a lot of different 100% answers.
Agree. Like I think we will cover the different aspects. And because like most things in personal finance, it's personal and it depends on your overall situation, what your goals are, what kind of lifestyle you want to live. But I think the goal of today's discussion is to highlight the different factors and help people make educated decisions around what are all the different inputs that feed into this question ultimately of how much do I need to retire? And so I think we can cover a bunch of different aspects of those inputs, talk about the things that maybe you and I have considered, and then really just kind of lay out the framework of how we think about it. And so other people can take their own personal situation and apply their situation to some of the things that we talk about.
Yeah, totally. You should be able to take these tools and apply it to your own personal situation. That would be success at the end of this, I think. So one thing that I think is worth starting with, Andrew, is back to your point about the FIRE community and this being kind of the big question at the crux of it, or the FI or FIRE. So FI is financial independence, FIRE is financial independence, retire early. But there's this, very well-known 4% rule, also known as the 25 times rule. And it is a super quick and dirty rule of thumb. But I'll tell you what I don't love about it. And I think many people get confused by it. And I myself have been confused by it. Pre and post retirement, I've been confused by it. But the rule essentially says that you need 25 times your annual cost of living to be able to retire. And that's the math at any age in theory.
Correct. And there are a couple key caveats for the rule. The rule came about as part of the Trinity study. So this study, Trinity University did a study, and they back tested the market, and they said if you were to take your current assets on the year that you retire and you were to take 4% out of those assets, so easy math, you've got $1 million in assets, you're going to take 4% out in your first year of retirement, you're going to have $40,000 to live on for your retirement for that year. And then you adjust it for inflation. So it does go up or down if there's deflation. And the key points of that are that it was designed for a 30-year retirement, and it has a 95% likely success rate. Right? Success rate is because
they can't predict all the other factors that could happen.
Correct, but based off of what they studied, 95% of the time that take your assets 4%, adjust for inflation every year, regardless of what the market is doing. So like the market could be down huge, 15, 20%, but you're still taking out that 4% every single year adjusted for inflation.
Yeah. So one of the things that I think is not as well communicated when people talk about that rule is the age and probability factor,
Absolutely.
right? Because like what you just said, just to double click on it, is it was always sort of, yeah, it doesn't matter what age, but you have people that are doing like that are pulling the plug at 25 or 30, and they have a much longer horizon of number of years they're not working. And so it's in theory kind of still holds true, but with a much lower probability of success than if you have, like you said, an average of a 30-year retirement.
Correct. So if you go up to, if you back test it and do some of the same analysis over 40 years, over 50 years, 60 years even, those probabilities of success drop dramatically. And so that's why it's not a great, it's good for hey, let's just do some quick math on it, but it really depends on your overall situation and what else you need to take into account.
And you say drops dramatically, but like in the probability world, it's a dramatic drop. Well, I'll give an example from early retirement now, Andrew, that you pulled and sent to me. If you're 100% invested in stocks with the money you have and you're withdrawing at the 4% rate, the probability of success if you have a 30-year retirement is 97%. The probability of success if you have a 60-year retirement, which would be what it is if you're retiring at the age of 30 on average, maybe you'd live to 90, goes down to 89%. That's still like a high probability. So a lot of people would still take those odds and would say, well, I'll adjust, I might spend less over time, or I might make some additional money. Like I'm not going to not make any money for 60 years, right? So we'll get into that, but there's a lot of things that can kind of sway that percentage.
Yeah, the general thinking now is that if the longer the horizon, you've got to discount that 4% a little bit.
Yeah. And then the other thing that I think is just worth noting, and we'll talk more about this, but when I first heard that rule, and I get so many questions from people about this, I thought, oh, that's your overall net worth. And I was like, well, not really. That really is like the part of your net worth that's liquid in some way, right? Because
invested assets that are generating a return. That's how I like to think about it.
And you want to, we'll talk about this more, but you want to break down those specific assets, right? Because some without penalty or creative like conversion ladders and other things aren't available till you're a certain age. So you want to make sure you have the right mix of assets in the right places. But
like a good example of that is like, I never include the 529 plan for my kids' college when I'm thinking about my calculations.
Right.
That's kind of carved out.
Yeah. And many people don't include their houses in those calculations because they plan on living in their house. Now, I know like Liz as an example plans on downgrading when she retires. She says she's, a bigger, more expensive house than she needs in retirement. And so she plans, so you maybe include half your house value and, whatever you're going to do. You can get very specific on it. But on that note, let's actually get into what do people need? How do you actually figure out what you personally need to retire?
Yeah. So I think you always have to start with the expenses on the expense side and thinking about what are your annual expenses. In order to know that, you got to be tracking your spending. And so expenses are key. A lot of financial planners talk about your expenses being lower in retirement. And I think that is probably more along the lines of a traditional retirement. Yeah. But in my modeling, I've modeled expenses to actually be higher because I think that you'll have more time if you are retiring on the earlier side than a traditional retirement at 65 or later in life. And so I've modeled mine to be 20% higher than our current run rate when I think about it.
Yeah. And there's a bunch of things that go into that again, you need to think about for your own personal situation.
Like I think you've said yourself that your expenses in early retirement have actually been higher than what you may have expected.
Yeah, exactly. And they've been higher. A big chunk of it is because of things that have changed and evolved with my kids and the activities they're doing and the expenses they have and things they cost more than they cost when they were younger. And I didn't really anticipate a lot of other things. I didn't anticipate that specifically. And I do have a lot more free time and I want to enjoy it with Greg. And sometimes that involves us going out and spending money. And I don't want to be limited. And benefits for many people will cost them more. And again, if you're assuming benefits when you're 65 or 70, you're assuming that you're going to be on Medicare, that you're going to have, other types of government sponsored support in your older age for benefits. But when you're 40, you've got to go buy benefits on the marketplace or privately through an insurance company. And they cost more than they might have cost when they were subsidized by your employer. So it could be kids. It could be that you want to plan, to fund a wedding. Like you need to think about your expenses now and your expenses in the future. And I know I did an episode with Greg. I can't even remember which episode it was, but it might have been one of the Friends on Fire episodes where it was how a family of 5 can afford to retire at 41, something like that. But what we talked about is I include included all sorts of, I know our average expenses, but I also included all sorts of unexpected things, like college costs more than I want, or I want to pay for more college than I'm expecting to pay for. There's a medical emergency. I remember I had a joke in there of I might need to buy a Tesla, and then we did. And so there's just things that you want to plan for. Your benefits costing more. It could be anything, but that you need to do yourself. And I actually was talking to someone the other day who said they just put in an $8,000 extra estimate per year of unexpected stuff. And I was like, oh, that's great. And that was kind of 1 year I'm going to need a car. They just kind of averaged out I'm going to need a roof at some point. I'm going to need, a new car. So these different expenses that will hit every 5 to 10 years, and I'll just average them out. So that's one approach you could take.
Yeah, in my model, I have a line for unexpected kind of one-time things like a car purchase, like putting in a car purchase every 5 years. One of us will get a new car every 10 years. So every 5 years, there's an amount set in there for a big purchase like a car.
And then if you retire, Andrew, you're going to need more bikes.
Yeah, I should add a line just for the.
Don't you think you'll spend more on your hobbies like that?
Yeah, yes, definitely.
I mean, I am finding that in some ways you save in other ways, but I do think,
I mean, you'll have things like you wouldn't have some of your commuting expenses. There are costs that go into going to work every day and your job, right? But I think those are going to be smaller. The increase in spending on because you've got free time, because you want to enjoy your hobbies, you want to travel. I think those are going to be bigger than the savings you get from the work.
They'll outpace the savings for sure. Yes. So the next thing you need to have a good idea of is your net worth. And like we said earlier, the specific types of assets and cash flow that you have. So what's your existing net worth and how do you forecast that net worth changing over time? So an example might be, like I said, Liz Gets Loaded has shared that, when she retires, she plans to sell her house and downsize to something that might cost half as much. So in her net worth, she can forecast in a conservative, influx of some amount of cash from downsizing her housing, around when she retires. It could be that you have rental properties and you're expecting some level of cash flow, whatever that might be, but you want to be able to have a good sense of what your assets are and which ones are accessible when. So I, for example, have talked pretty openly about how we're funding our retirement, and the next 10 to 15 years are heavily funded by my deferred compensation plan and some rental property income and tapping into some investments. But most of it, I'll tap into investments after that or as needed before that. And everyone's is different, right? Some people don't have a DCP. Some people will rely 100% on index funds and money they have in the market. And that's, very liquid and you can pull it out as you need it.
Yeah, I think the key thing is just all those assets that are generating returns. Those are the ones to include. So a brokerage account, your IRAs, your 401ks, and kind of putting all those together when you think about the total asset pool, and then thinking about the withdrawal percentage that you're going to use off of that asset base.
So the other points that are related to your expenses and your net worth and or kind of future cash flow is, like we mentioned earlier, you want to do your best. It's not going to be perfect and don't overthink it, but just do your best of what you know for your own personal situation. You want to forecast things out with the details of your life so that you have a specific plan for how you will fund your retirement based on your specifics. So we've given a couple examples already, but it might be that you've got some amount of passive income that's happening now and will kind of grow in the future. It could be rental properties. It could be that you plan to quit and then do a little bit of consulting and you're going to kind of forecast what that income looks like.
Yeah, like one thing I think that's really important with those additional streams of income, they're very valuable. They're 25 times valuable, right? If you think about it okay, if I can generate $4,000 in cash flow for the year, I need $100,000 less of capital of assets that are generating returns. I need $100,000 less. So a small amount of additional income can make a big difference in the asset base that you need. So having any type of additional income, if it's part-time or if it's through the rental properties, any type of cash flow can really help the math in terms of calculations.
Yeah. I remember Greg looking at this when we were retiring. And it's one of the things that led him to start playing around and doing some Ubering, because he was like, if I can make 10 grand a year versus nothing a year, it will dramatically change the probability of success and the amount that you're having to tap into pulling out reserves that are earning really solid interest rates right now. So yeah, I would say, don't sleep on how much a little bit of income can dramatically change your numbers. Or if you're like me, I want to be really conservative. I don't even include that income, right? Assume the worst, which is like whatever you think is going to be your side hustle doesn't work out, so
Right.
assume that. I also assume the worst on things like Social Security.
No, I was just going to mention that, Social Security is a big X factor in the cash flow when you get into your 60s, and the conservative side definitely suggests to not include it. I truly believe that Social Security will continue to be around. I think it will potentially have some means testing. It could be a lower amount, but I don't think it was simply going to go away at any point, but it could look differently than it does today. And the conservative approach is don't include it. If it happens, it's a nice to have. Other people say, hey, I'm going to include some percentage of it, right? It's very easy to look at your Social Security statement and see exactly what your monthly income would be from Social Security based off of the age that you decide to start taking it, and model that out. And some people will just put a discount factor on it. They'll say, I'm going to take 75% of that, or 50% to include in my model numbers.
And I mean, all of this to me depends on the reality of your model and your situation too. So I 100% agree. If you were to ask me to predict, I believe we will get some level, like people, Andrew, people our age, when we hit that age, we will get some level of Social Security, but I'm just not counting on it. It's going to be like icing on the cake, right? But if you are like miserable in your job and you're doing these calculations, and the difference between you feeling comfortable leaving or not is like that, that over under on if Social Security is going to happen, like assume, you don't need to be that conservative about it. I just like, I can assume worst case scenario and still feel good about pulling the plug. But again, if you're on the cusp, all of these things are levers that you can pull up and down. And like, you don't need to assume the worst on everything, because I don't think the worst is going to happen on every single thing. But you just want to go into a big decision like this, regardless of your age, very thoughtfully and intentionally, and just thinking through all of these specific things that could be a cost or a plus in your early retirement scenario, or not early retirement, in your retirement scenario. But the other things you want to think about are just all of the different assets you have, right? So it could be not just your brokerage, but it's that you've also got an HSA, a health savings account, which also is money in a brokerage.
It's interesting. When you say HSAs, I actually don't include the HSA in my modeling. I think about it like the 529 plan a little bit with the kids, that I know I'm going to have some medical expenses and I don't want to count on those funds to be generating income. I kind of think of it as a separate bucket.
Yeah, that's interesting. Which again, I don't have enough in my HSA for it to swing me one way or the other strongly, because I only participated in it in a handful of years. But yeah, those are the sort of decisions you need to make.
Yeah, the three key assets that I exclude are the house, the 529, and the HSA from my models.
Okay, so on the flip side, the assets you do include are basically your brokerage funds.
Brokerage, IRA, Roth IRAs, or IRAs, 401k, and DCP.
Got it. Yeah. Okay. Which is all money in some version of the market.
And then based off of what it is, it determines which gets pulled out earliest and which gets pulled out latest, right?
Another couple of things that I would say you should think about as you're thinking about your own personal scenario is understand how you're going to be taxed around some of your different income sources, because it can make a huge difference. So you just want to think about that, right? It isn't when you're working and when you are retired, you still pay taxes, and different types of income and accounts you're pulling things out of will generate taxable income. Some of them will, some of them won't, depending on where you're pulling your money out of. But you want to think about that in your forecast and kind of as you're thinking.
I definitely include taxes in my models, and depending on the bucket, an estimated tax rate depending on what kind of funds are being pulled from it. I think that the key thing with taxes are, one, they can change, right? Who knows what Congress will do. Second is generally the US tax system is very skewed towards income. And when you're retired or early retired, you're not generating a ton of income. Now you may have rental properties, you could have Social Security, all that will count as income. But if your primary source of funds are living off of the investments, you're going to have very little income. So you're going to be in typically a pretty low tax bracket, and you can manage those tax brackets via how much you decide to take, and you can be very strategic about it.
It's why you and I have both participated in our company's deferred compensation plans, because we were trying to not accept money when we were in a you're still in a very high tax bracket. I am now in a low tax bracket, and I'm happy to receive small chunks of that money over time because I'm getting taxed at like, I don't want to say all the rates, but like 20% plus less of a tax rate than when I was
lower tax rates.
It's a very meaningful amount, and it really
and
can
also,
add up in a positive or negative way.
You can, there's the standard deduction that you can take every year. And then if you're, married filing jointly, it's even higher. And you can definitely take a significant chunk of income and not have to pay any taxes on it. And then also you're not going to have to pay capital gains because you're going to be at a certain threshold. So all of that adds up to a very advantageous situation for people who are retiring early from a tax efficiency perspective.
Yeah, it's part of the magic of FIRE is people have strategically planned, all of this out to optimize their income and taxes over their entire lifespan versus the old traditional way of, we work for,
right.
I don't know, 50 years. Is that the math? That sounds depressing when you say it that way. I'm really loving my 20-year career lately. But okay, another thing that I think is just, and we're going to get into withdrawal strategy and some more specific tools and resources here, but just some things we want people to remember here is, you, as you're modeling all this out, which again, we'll come back to in a little while, but you want to make sure that you have the right amount of money to cover your living expenses every year. And there's all these models, and we'll get into that because Andrew, even when you keep referring to your model, I'm like, where's your model? Is it in an Excel sheet? I'm just curious. I'm sure it's a custom built.
It's an Excel sheet. Yeah.
But there's a lot of other tools, and we'll share some of those at the end of where you can go and model this stuff out using other tools that are available for free and for purchase. But one of the things that I personally like, because you plug numbers into a model and it kind of spits stuff back out to you. I've used this life planning sheet. I actually recently put it on Etsy. It's $3 if anyone wants to buy it. You also could just email me and I will send it to you for free though. If the $3 is in
That's
any
great.
way of it. Andrew, you can have it free.
Thank you.
It maps things out by year. I was actually just using this with a coaching client recently. So what I like about it is the visual representation. So for example, I've visually mapped out that my DCP will cover my expenses for 10 to 15 years. It's I don't know why I keep saying 10 to 15. It changes amounts in after 10 years. And so it's kind of, different percentages it covers, but it's a huge chunk of what I need for the next 15 years. And I can see that. And then I can see, okay. And then at that point, I'll be this age and I'll be pulling from my brokerage. And by then that brokerage will have, based on, modest returns, will have grown to this amount. And then I'll be 65. And then I can start pulling from my 401k without penalty. Or if I was in any of those years, if I was going to start to run out of money, I could start to map out a 5-year conversion ladder to be able to access my 401k penalty free, which we're not going to get into in great detail in this episode, but there are ways to access your 401k early without penalty. And the quick name for it is a conversion ladder, and it's a 5-year process. And so there's kind of a waiting period, but you can plan in advance for stuff like that. And so I find it very helpful to actually map out year by year how you're going to fund those years. Sometimes your first couple years early retiring is from cash that you've kind of cash reserves you're going to live off of before you start to tap into your brokerage account, whatever it might be. But I just think visually mapping that out. Andrew, does your model
Yeah, I 100% agree with that. So my model is, I'm being optimistic. I'm hoping for, 50 years. So I've got 50 columns going across the top, and so it can create a very easy visual representation. I've got all of the assets on the left side, and I model out the balances over those 50 years. And then I've got all of these sections where I can plug in percentages that I'm either reducing by that generate cash flow. And then kind of at the bottom is whatever percentages I set, then that generates a certain amount of cash flow. And then that gets down to my expenses, and I kind of zero out against my forecasted expenses. And then I've got assumptions in there in terms of what the market returns will be and then what inflation will be. So yeah, I think the visual aspect has been super helpful for me as I've kind of modeled things out.
Yeah.
We should definitely do a model share, by the way.
Yeah, I was just going to say, I feel like as you were saying that, I was like, I feel like we've talked about how we should share these models. We will. If we weren't both so busy, we probably would have done it in advance of this episode. So the thing I love about the way you're talking about your model and the kind of life planning sheet I'm talking about are when you plug numbers into some other FIRE calculators, or like the CFIRE sim tool, which we'll put a link in the show notes to, they're great and they're helpful, but you kind of like put some numbers in and then it spits out some probability of, how likely it is that you're going to be okay versus run out of money, which is helpful. It makes me feel better, but I want to see it year by year, right? Like I don't want to just spit some numbers into a model that like a black box where I don't know what it's calculating exactly.
Right. And it's like just for example, like Crystal is a former teacher. She has a small pension that kicks in and when she's 60 years old. So I've got a row for that when she hits 60, that's when the pension starts. That's where that hits the cash flow. And so like just being able to map that out and just think through, okay, at 72, you're going to start taking Social Security. That goes into the cash flow field. We're going to live off of DCP for the first couple of years of the retirement. And then we'll draw down on the brokerage account. Then we'll move on to the IRA account. You want to, set the IRA, you want to be careful of getting hit with big RMD requirements at 72. And so you want to manage down your IRA so that the RMD are not huge. And then, you then kind of the Roth IRA is the backup because it's so tax efficient. That's the last bucket that you want to touch from a tax efficiency perspective. But yeah, you kind of have all of that kind of mapped out in an Excel sheet.
And I say, don't let everything that Andrew has in his Excel sheet overwhelm you, because without us sharing our different sheets, I'm just going to venture to say your Excel sheet is more advanced than my Excel sheet. So yours is great. And that's awesome if everyone has every single one of those factors that they're able to like edit. And there's other tools out there that, many that you have to purchase.
You can go as simple or as complex as you want. Like for example, my sheet I do take in taxes into account in mine, but you don't have to, right? You can just assume you could assume a flat tax rate. I'm going to assume 18%. It's pretty safe, right? You could do something somewhere in the 15 to 25, pick a number, and then you're just going to assume, okay, just knock whatever that is off of the cash flow. And you can definitely make things simpler.
Yeah, very true.
Taxes make the model much more complex.
Yeah, you can just assume your expenses are higher, and that kind of covers tax, right? Add 20% to your expenses and then like feel good that you've kind of covered for a tax budget, if you will, that's worst case scenario. Okay, Andrew, I feel like we should talk withdrawal strategy, because
yes,
that is something that I think people have a lot of questions about. Like you're trying to figure out if you can retire, and perhaps you've now hopefully got a better sense of all the things that you should take into account there. But then what does it actually look like to access all that money?
So one thing about the 4% rule is it's kind of like what I refer to as the middle of the road. And I think you can go on either side of it by 1%. So kind of I think about a range of 3 to 5%, 3% being very conservative, 5% being on the more aggressive side, right? You're going to potentially hit some much higher probabilities if you're axing 5%, and you're going to have a lot more safety at 3. So I think it's important to model between 3 and 5 to understand the risks that you're taking or the conservatism that you're applying at different withdrawal rates.
And to be clear, those percentages you were naming, Andrew, those are the withdrawal rates. So that you gave the example at the beginning, but like when you say 3%.
Right. So I like using like, what does it look like at 3%, 3.25%, 3.5%, 3.75%, 4, 4.25%, 4.5%, 4.75%, and 5. And so if you look at those numbers and you build in a sensitivity table of, okay, this is what my cash flow looks like off of, an asset base of X, and you just make that a variable number that you can play around with. And, there are a bunch of calculators online that will do this, but it will give you a pretty good idea of, okay, if just for easy math, right? If I've got $1 million of assets that are generating returns, if I'm going to be at 3, I'm going to have $30,000. If I'm going to be at 5, I'm going to be at $50,000. And so you've got to think about your lifestyle, your expenses, and kind of what you're comfortable with. If either you can have a smaller asset base and a higher withdrawal percentage, right? Or you can go the other way. It just depends on what you're comfortable with. And one thing about the Trinity study that I think is probably its biggest flaw is it assumes a fixed amount at the beginning of retirement, and it doesn't adjust except for inflation. So think about that. If the market is down 20% and is having a terrible year, it assumes you want to maintain the same lifestyle. And so it assumes that you would take out the exact same amount as you did on the very first year that you retired. That's not typically how people will react, right? Most people, I think, will adjust their spending and lifestyle a little bit if the market is completely tanking.
Yeah.
And so if you're willing to adopt what's referred to as a dynamic spending strategy, you can significantly improve your probabilities if you can have, you know, a range of spending, within bands, right? So you don't want to kill the lifestyle completely.
Like you're not going to move houses, but you're going to
Right.
say like, yeah, we're going to eat out less.
But like in my original like $1 million example, you know, if originally you were taking out 40, and you know, if the market's having a down year and you're going to take out 30 instead of 40, that can have a huge impact on
Even
your
35.
Yes.
Right? Like, yeah, just cutting out a vacation or, you know,
Right.
I love the dynamic approach because you're in control, right? So if this is not like a set it and forget it thing, right? Like you can adjust things just like you do when you have a job and when you're not retired. Like you make decisions on what you're willing to spend based on realities of things happening to your finances around you.
So I think that's flaw number one within the Trinity study. And I don't think people would necessarily, I understand the reasoning behind it, right? The reasoning behind it is I want to maintain the same lifestyle in retirement, right? But I think you can adjust some human behaviors there to enhance success. The second thing with the Trinity study is it assumes a net balance of zero at the end of retirement.
Die with zero.
It is very in line with the die with zero principle. However, I think most people don't want to cut it that close.
Or can predict when they're going to die.
That too, right? And so, you know, if you, let's just do some more simple math, right? You decide you wanted to, you know, retire on the earlier side at 50, and you have a 30-year horizon at 80, but you end up living to 90. You followed the 4% rule, and you suddenly have zero money at 80, right? That's the worst case scenario. And what I like what Early Retirement Now is modeled is they will go through some scenarios with the asset base to be at 25% of the original balance, or 50% of the original balance, or 75, or even 100, right? So they've come up with some models that say we're not going to model this out to be where the assets go to zero. So I think I really like those charts to look at because I think that adds a level of buffer. And, you know, for those of us who've got children, that, you know, people, you know, certainly we want to leave some funds for our children, not completely die with zero. So I think that's something to take into consideration as well, and is a slight flaw of the 4% rule.
Yeah.
So how did you think about your withdrawal rates and withdrawal strategies and kind of conservatism to aggressive?
Yeah, I mean, I'll be really honest. I didn't think about it in great detail. I had some rough and tumble, some like rough and dirty numbers of, I knew our expenses pretty solidly pre-teenagers, and I knew our net worth. I knew what my DCP would be. I mean, you know, again, some factors of kind of how that grows in the market over the next 10 to 15 years. But I knew the 25 times rule. I knew the 4%, everything you're talking about. I knew I was fine based on that. I think at some point I probably did some 3% math also. And there were a lot of, I mean, I did include our rental properties because I knew we could.
Absolutely.
They're providing passive income now, and we could sell them whenever we want. Again, barring some like crazy drop in the market for a couple of years, but like overall, if I go back in the last 30 years, like I could have sold them 29 out of 30 years, you know, without taking a big loss. I mean, so, and then I would do things like I did use some tools like the CFire Sim tool to just do some general probability checking, and I mapped it out year by year with not even all the details on like taxes and inflation rates and other things. I just generally knew I had enough, and I had done some padding, like some padding of kind of worst case scenarios of like these big one-time expenses over the, you know, next 10 to 20 years for like when the kids were in college. I threw some extra expenses in there, and I did more simple math on what I would have and how my expenses would increase over time and where I was going to fund that. And then again, I did the like mapping it out by year. I roughly did the 25 times math and knew that I was, you know, more than good on that. And I didn't go go significantly further than that. I was tired and stressed and ready to leave my job.
Yeah.
And I also knew something that I often tell people, I could always go back to work. I mean, I was like, I'm really good barring any like crazy emergencies or things I can't predict, you know? And I did take into account, this is actually important to note also, going back to the things to take into account. I roughly took into account the fact that both of our parents, all of our parents that are, you know, still alive, generally can take care of themselves financially. So if they couldn't, I would have included that in my forecast of like, hey, we're going to have some costs associated with that. And again, something crazy could still happen and there could be some we're not expecting, but overall, our parents are in a, you know, financially secure situation. If your parents aren't and are more financially insecure, I remember Kirsten and Julian from Rich and Regular talking about this, right? If they're not, you need to forecast that in, right? And the other thing I knew that made me feel better about kind of having a rough view of my numbers, Andrew, was I could always go back to work.
Yeah.
And I'd probably end up making some money that I didn't even forecast into this because I'd get bored, I'd start some project, I'd, you know, start making money off, you know, XYZ. And it wouldn't be the kind of money I made before, but it would, like we said, those small amounts can make a dramatic change in how fast you're withdrawing your money and then, you know, how much longer your money's there to continue to grow.
So you hadn't taken all right, when I can get to, you know, I want to be at 3.5% or I want to be at 3.25%. You hadn't gotten down to that level of detail.
No, not at all.
Okay.
No, and I still haven't, because what I have looked at is, and I think I've put this on Instagram before, I currently have more money than I had when I retired, and I'm, you know, a year and a few months into it. And some of that is market performance. Well, I mean, a lot of that is market performance, but I'm seeing how fast I'm spending down. I mean, I haven't touched any of my investments yet.
Yeah, that's going to be I've thought about that quite a bit in terms of, you know, in my model, what is the first year that I have to actually sell some investments?
Yeah.
Right. And, you know, that's kind of like an unnerving, because essentially you've switched from accumulation to withdrawal.
Yeah, decumulate.
Right?
Yeah.
So that's kind of like a key milestone that I hear people talk about quite a bit, is at what point do you actually have to start selling the assets?
Yeah. And my forecast on that is definitely not in the next 10 years.
Right. Because the DCP plus the rental income helps to cover most of the living expenses, right?
Yeah. And cash reserves that I have.
Right.
Right. And so it's a mix of those probably three things and some, I was going to say like passive income, but that's mostly rental properties and that's not passive anyways, but same idea. And so, I've not done as in-depth or as forensic of an analysis as you've done upfront or on the withdrawal, to your point, right? On my withdrawal rate, but I still feel very positive and confident about it. I'm not sure I would have said that right when I was quitting, but being a year in and kind of seeing how, I mean, I'm actually spending more money right now.
Yeah.
I know a lot of that's variable and controllable too. So I know that if, like we were talking about, if I hit a rough patch and I had something really unexpected come up, we spend $20,000 to $30,000 a year on travel. Like I could pull that back overnight if I wanted to, and I do love to travel, but like, it'll be okay. I'm not taking the kids internationally for a year and like the world's not going to end. And so I feel like my approach is a little, what would you call it? Ross?
Maybe a little less scientific.
Yeah, a little less scientific, but good enough.
Right.
If that makes sense. I feel good enough about it for so many reasons, because I can always go back to work. My goal, one of my like short-term goals was, and Greg and I, to like be around for the next 10 years that our kids are still in the house with us. Like I have no worries over the next 10 to 15, 20 years. Yeah. I'm going to end up doing something. I'm too wired the way I am. Right. And I'm never going to, I don't believe I'll ever, people always ask me like, I don't believe I'll ever go back to a corporate job. Not saying I won't do a little bit of consulting here and there, like something else.
You can shadow me for a day if you'd like to get some, if you miss your corporort job.
Remind myself why I don't want to go back to it. Do I have to ride my bike to work like 20 miles or I'm going to be like, really, you're going to be like, I'm late for work today because I was waiting for Maggie to.
So one thing you mentioned that I think is important to talk about, you mentioned how the market has performed pretty well since you retired, and probably the biggest risk to earlier retirement is sequencing of returns risk, right? And so that's the concept that the first couple years of your retirement are really important in terms of how the market performs. performs. So if your timing is really poor in that you decide to pull the plug and suddenly the market goes into a huge recession, think like the financial crisis, right, of 2008. People who retired at the end of 2007 saw their portfolios decline dramatically. And if you think about it, if you retired, you're not building those balances anymore. The market declines, those balances go down. Now your retirement is off of a much lower base. And so the first couple of years can make a big difference in terms of how the assets perform over a long horizon. And so that's what's referred to as sequencing of return to risk, where those early years are really important. And on the flip side, if you have some really good years, if the 5 years following your retirement, if you have some very good years, you can get more aggressive on your withdrawal rates because you essentially the balances have built up in those 5 years more than they would have in a down market.
Yeah, and more than they're going to increase if there's a couple bad years, after those, good 5 years. The other thing I often think about with the withdrawal strategy, I know, Andrew, you were like, you like the idea of like waiting as long as you can to start having to pull out of your brokerage funds. So when you do finally start pulling out of your brokerage funds, it's not like you're taking out a whole year's worth of money. Mm-hmm. It's not like the market's down at one point. You've got to take out $100,000 for that year's expenses or 50 or wherever you're at. And you're taking a big hit on that amount of money. You can take out money in small batches as you literally take out money every other week or monthly or whatever makes sense because if the market's down, you'd be like, wait, see how long you can kind of like get lean for a while. You kind of made this point earlier, right? But you can adjust your spending based on what is happening, but you can also do that in like micro doses, not at a whole year or a couple years level. You can do that every week and month.
So that's an interesting point that early retirement now, they made an adjustment where the Trinity study assumes pulling the money out for the full year. They adjusted their modeling so it's every month. And so, because that's how people would operate, right?
Yeah.
One question I had for you was, how do you think about dividends? Have you changed your investment approach so that you're not reinvesting dividends anymore? Because I've thought through that as, once you're in retirement, I would probably flip it so I'm not reinvesting dividends anymore. How have you approached that?
I haven't. I actually was just going into my account to triple check on all the different funds I have that they're automatically reinvesting dividends, because I found a couple where it wasn't. They were putting out small amounts. So
this is where the simplified strategy of VTSAX is helpful, right?
Well, I have a simplified strategy going forward. I have a historically old crap that I'm dealing with. I actually sold a ton of stuff this week.
I saw that. Congratulations. Yeah. Nice job. I keep telling my mom to do the same thing and she won't listen to me.
I sold a bunch of stuff and I have a bunch of capital losses. I haven't sold. I'm scared to sell some stuff I need to simplify some stuff that have had gains on them, but I'm scared to do it till I have a better look at our income for the year, because I want to kind of like time that out better.
Yeah, you want to do it in a year where you have low.
Yeah, exactly. And I'm just not this is like our first full year, and I'm trying to. I might sell some stuff like the last week of December. But one thing I tried to sell was so bad. It's actually a Canadian stock, and I didn't know that when I bought it, for what it's worth. But it's a company that like Greg was reading some article, but I'm not even getting what it was. Is why I don't buy individual stocks.
Reason number 582.
Reason number,
you should buy
yes,
VTSAX.
6,000. Yes. And so I tried to sell it. Fidelity wouldn't let me. I was getting these weird error messages. Even the like chat support couldn't help me. And he was like, you got to call our international trading team. And I was like, okay. And the guy on the phone was so helpful. He was like, okay, look, this company filed for bankruptcy. They're in, and I already knew that. I knew it was worth nothing. I was like, but dude, I need my $700 in capital losses. That's all I want. I don't care that it's worth $17 right now. Could you please? And he's like, I can't. He's like, they're not allowed to trade right now because they're like in the process and someone's buying them likely. And so he's like, and then a tiny part of me is like, oh, maybe this company isn't dead yet. Maybe I'm going to get rich off this. But anyways, I just wanted to get rid of it. I cannot get rid of it. I'm blocked until they like reopen it, which may never happen. So I was like, you're telling me there's no way I can realize these capital losses? I would like to. They're my losses. I would like them. And he was like, yeah, nothing you can do about it. Anyways, reason number 6,012 on why you should not buy individual stocks based on articles you read about things that you think are going to be up and coming trends. Oh, dividends. So no, first off, I don't yet need those dividends, back to the point I was making earlier. So I don't want them yet. So I still want them to be reinvested. And I also like to be able to control them. So the only thing I don't like about when your dividends aren't reinvested is they just dump out when they dump out. And
Every
you can't,
quarter.
yeah. And you don't know, I mean, you can't predict the amount. I mean, I guess you could kind of slowly predict it over time.
I mean, like on VTSAX, typically it's about a 1.5%.
Yeah. Either way, whether my dividends are reinvested or whether I'm taking them, either way, I'm paying taxes on them.
Correct.
In this year.
Right. Essentially, what you're doing is you're getting a dividend, it's taxable income. And do you decide that money to go into your bank account, or does that money go back into the account in order to buy more stock? And so you can achieve the same thing even if you keep the dividends reinvested. So you could say, well, just go sell some stock, and you're gonna have the same effect essentially. It's just from a simplicity standpoint that money just gets deposited in your account every quarter, right?
Yeah. We talked about this on the rental property episode with Greg, where somebody had made the point of when you're getting money that's earned through your rental property business, it feels different than selling off stock. It feels more like you're getting a paycheck kind of, So like psychologically, you feel better able to receive it than if you have to like go sell off investments. And I think having dividends set to pay out as cash versus reinvested is probably the same way when you start to need the money. Because like either way, I'm getting hit on the taxes. I never noticed the taxes before because those dividends were such a small percentage of my overall income that I just didn't even notice like the amount I was paying. And now like the other day when I was selling off this stuff, I went to look and see what my dividends were year to date because I was like, I'm trying to manage my income now for tax purposes and for our medical subsidy and for a bunch of reasons. And so all of a sudden I like care and notice about the dividends more. But to answer your question, yeah, I've not changed my approach there. I might when I'm actually relying on those things.
Yeah, it's like I've modeled it out that the dividends are going to be significant, and so like the ultimate power play is you can live off your dividends out of the brokerage account, right? Like
that is nice. A big chunk of my money is in FC Rocks, which is like a Fidelity Zero version of VTEX. They pay out dividends at the end of the year.
Okay.
They sort of like, I was researching
Really?
this. They like,
That's
yeah,
weird.
I know it is weird. There's a whole article about it on Personal Finance Club. And it actually was edited. I'm going to send you a link to it because it's really interesting. I read it and then I was like, why am I in this? And then they edited their own article because they said something bad about FC Rocks. And then about the way they pay dividends and how it was actually like made it basically like not as good of a fund. They said like, otherwise FC Rocks is actually comparable. And then they went and I was like reading it and I was like really bummed out. This was earlier this week when I was selling this stuff. And then it said, while FC Rocks does only pay dividends annually, the conclusion below is largely incorrect. FC Rocks actually reinvest those dividends internally to the fund throughout the year. And the growth is reflected in the share price. They just don't show you the dividends. So it says you can see this because they pay the dividends are paid in December and the share price takes a hit equal to the dividend payment, the difference between the two funds. So I don't see the dividends till the end of the year versus you see them quarterly on other ones.
On Vanguard. Yeah. Okay. It's at the end of the day, it's semantics, right?
Yeah.
It really like, it's kind of like I had this conversation with my mom last year because she was having a hard time understanding it. And I said, you could, if you own a stock that doesn't pay any dividend, if you just sold 2% of your stock, you could quote generate a dividend. Like it's just how the company decides to return capital to shareholders. Some companies decide, hey, we're just going to continue to reinvest in the business. We're going to grow earnings per share, which is going to grow our stock price. Or other companies are going to say, no, we got excess cash. We actually don't think we can invest it as well as you. And so we're just going to give it back to you as a dividend. So it's really just about capital strategy.
Yeah. And on that note, I have a couple of funds that I had maybe like 10 grand total in a couple of different funds that Mike at some point had suggested that were high dividend funds or companies. And they're doing like terrible. And they have been for a long time. Why is that? And I was like, they were some of the ones I want to sell too. They've all got losses on them.
I mean, like traditionally, all the technology companies don't issue dividends because they're reinvesting and they're trying to grow the business and high growth. Whereas somebody like an ExxonMobil or, some of these historical Dow companies where they're just generating lots of good cash and then they just deploy that in dividends.
Good. Okay. I think we can like mention some of these tools if we want. We kind of already talked a little bit about it. There used to be some like good fire tools, but I don't know what they are now.
I mean, C-Fire Sim is definitely pretty good, but I actually don't find them more of just like a, hey, ballpark, yes, they can account for certain certain stuff, but I find the visual Excel and actually how are you going to map out your specific situation and how are you going to access those funds? What percentages are you going to use? And how are you going to generate cash flow? Because ultimately that's what are you going to do to generate cash flow? And how are you going to do that? And what are the percentages that you're going to use?
Yeah, I think that's a great point. And again, we can put a link to some of these tools like the CFire Sim tool. But again, those are simulators.
Yeah, they're
that are
simulators
showing the
and
probability.
they're back testing with probability and they can put you in the right ballpark. And they are helpful in terms of seeing what different inputs, how they drive results. And so you can play around and see that if you put in a crazy 6 or 7% withdrawal rate, right, the chances of failure are extremely high. And then, you could change, for example, CFire Sim, you can adjust the ratio between stocks and bonds, play around with that. You can say, what if I start with a bigger pile, right? Like what if I start with larger assets and take out higher percentages in order to fund a, fat fire lifestyle, right?
Yeah.
I mean, a lot of this comes down to lifestyle, right? Do you want a lean fire, regular fire, chubby fire, fat fire?
Chubby fire.
I like chubby fire is a good one. Chubby fire on Reddit.
Chubby fire.
You haven't heard of chubby fire?
But maybe you or someone mentioned it recently. I think I might be on chubby fire. I don't know if I'm fully on fat fire. Maybe I am. Wait, what's the I forget the definition of fat fire. I don't like these terms in general. So let's move on. Okay. The other thing that the CFire Sim tool is helpful for is like playing around with, if I have an extra 10,000 of income that's, from side jobs and other things, then how will that adjust the probability of my success, right? So it's good for some like quick and dirty stuff like that. But ultimately, I think you and I, Andrew, are both on the manual spreadsheet and mapping things out year by year with formulas. So you're not like, you can drag this stuff over once you build the formulas. And maybe, Andrew, someday we could do a template off of your...
Yeah, I was thinking about that, right? It's definitely not public ready.
Not user experience designed yet.
Yeah, but I think maybe we can work on that at some point.
Yeah, someday. Future goals. When you have time in between winning national championships and stuff. Okay, I think we're good.
Anything else?
I hope this has been helpful for people. I hope this helps people to understand what they need to retire, and that the answer to that is different for everybody. And you've got to take into account your own personal situation and all the different levers you can pull and think through all of those for yourself. And then to go talk to other people, because it is helpful to have people, and a lot of people in the FI community are willing to talk and share and, on a one-on-one basis.
Yeah. I mean, I kind of what we were saying at the beginning, like this is the fundamental question, and how people approach it and the percentages that people are targeting is the most important thing. And, for me personally, I lean on the very conservative side. Shocker. I know.
You do, because you could be retired right now, Andrew.
I'm targeting I want to be in that 3% range just to have plenty of buffer and make sure that, lots of different scenarios are accounted for.
Yeah. There's nothing wrong with that. That's why it's called personal finance. You do what makes you comfortable.
I forgot there was one other thing I wanted to do. I wanted to talk about the mistake I made on the last one and correct it.
Let's do it.
Yeah. So we got a listener, I was going to say reader, no, a listener question about something I said on the last episode when talking about mortgages and the impact of additional payments. And so what I said was that for every, if you just pay an extra $100, that you can take 9 years off your mortgage. And the listener, very rightly so, said, I can't come up with any math that actually does that.
She was like, there's no interest rate where that math plays out.
They are 100% correct, because I left out a very important detail that $100 is for every $100,000 that you have on your mortgage. So if you have a $300,000 mortgage and you put an extra $300 a month on, it will take 9 years off at a 6% interest rate. Right. So obviously the size of the mortgage, the interest rate, and the payment and the amount that you're paying is very important.
Right.
But that's the simple math on it, is that for every $100 for every 100,000 of debt that you've got at a 6% rate will take 9 years off. And so that's still a big chunk, right? So even if you have a $300,000 or $400,000 mortgage and you're putting extra $300 or $400 a month on it, which is that's a small car payment these days, will knock 9 years off your mortgage on a 30-year.
Yeah. So said another way, Andrew, you said it right for everybody out there who has a $100,000 mortgage, which sadly probably isn't a lot of people.
It's just not a lot of people. possible. Correct.
It's not realistic in a lot of markets, but we really do appreciate the person who
Yeah,
reached out.
The
to
feedback
correct
is
that, 'cause
great.
it's always
We
helpful.
love hearing from people. We love feedback on it, and certainly if we've said something that's incorrect, we want to set the record straight and correct it.
Yeah. Okay. It's officially been corrected. Well done, Andrew.
Thank you.
Okay. I hope this is helpful. Thank you guys for listening. We know your time is limited. We appreciate you spending some of it with us. If you've enjoyed this episode, we always appreciate a written review on Apple Podcasts. You can also leave us a rating on Spotify. If you've done that already, thank you so much. If you want to go do it, thank you so much.
We also encourage you to share this episode with a friend or family member to encourage ongoing discussion about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you. And you can leave us a voicemail or text us at 404-981-3370 or hit us up on Instagram.
Okay, Andrew, when are you going to retire?
That's a great question. As soon as Crystal wants me hanging out in the house, which is, I think, a long ways off.
Oh, okay. Wow, that's funny. That's a good strategy on when you're allowed to come home again.
I in all seriousness, I still enjoy what I do, and I like working. Yes, there are some days that are more challenging than others, but overall, I enjoy what I do, and I don't think Crystal's ready to have me at home yet. So
yeah.
we will keep working.
I feel you on that. Okay, thank you. Good discussion. Hope you have a great night. Bye, Andrew.
Great. Thanks, Maggie. Bye.
Bye.